tax planning forms that you are ever going to find for international tax. You look at it a lot better. If I didn't hit the wrong button, hold on here. Okay. So this is Schedule M with the Form 5471. And there's a similar form for transactions with a foreign partnership and transactions with a foreign disregarded entity. But nothing is more important than a transaction between two corporations, two C corporations especially, and a controlled foreign corporation is always a C corporation. And so I have on the form, on the video here, on the screen, the instructions and the form. And tax planning, you know, I was thinking as I was preparing for this, and this will really show you my age, but I remember how much fun it was belonging to the automobile club. And if I was going to go on a road trip or take a family vacation, I really enjoyed meeting with the travel consultant. You kind of map out the trip with them. They would then put together a package, maybe have, I don't know, 50 pages that would flip over that would show the route you're taking and what's going along the way, and you would really plan it. And I realized that people who are working for us today, few of them actually planned out their road trips. They hop in the car, they put the address in the GPS or now the iPhone, and off they go. And that's not what you want your clients to do with international tax planning. You want to go back to, I hate to say it, you want to go back to about 1969, 1970, 76, when you went to the automobile club and you methodically planned out your trips for road stops and sightseeing, whatever you wanted. And that's how you're going to have your clients save money. And the advantage of you having your clients save lots of money, he'll be happier to pay you lots of fees. At least that's what we hope. So when the client says, I am going to be doing a foreign corporation or foreign transaction, there's a few forms that I'd like to pull out. One is Form 926. We talked about that. That's how you're going to capitalize it. I want to remind you of the importance of debt versus equity. That's going to come up on this form. And it can't be emphasized too much. Schedule M is filed only by the Category 4 filers. Remember that from our discussion on that. Category 4 is a U.S. person that owns either more than 50% of the voting stock or 50% of the value of the company. And this is where debt and equity can get you into big trouble. Because if you do a loan to a foreign corporation that's thinly capitalized, it's going to be equity. And that loan may be worth more than the value of the corporation. Not uncommon because it's thinly capitalized. Remember, we just used the term thinly capitalized, which means the ratio of net worth to debt exceeds 1 to 5. That's the outside safe haven for related party loans. 1 to 3 is the preferred ratio by the IRS. The national office is really big on this topic. And so you should expect it to be a big topic if we have a tax audit. And what happens now if you don't file all the information returns, you, the CPA, have the tax penalties. The client has them and then he passes them on to you. So that's what's important in the debt versus equity. But back to good news, good tax planning. So this Schedule M is a great form because it tells you a lot. It tells you on the column here, transactions. I'm going to enlarge this form in a second, what type of transactions are imported. And it tells you as you go across the form what type of related parties are important. So one is the person filing the form. That's column B here. Any domestic corporation or partnership controlled by the person filing this form. And control is going to probably get you into the constructive ownership rules. Any other foreign corporation or partnership controlled by a U.S. person filing this form. Okay, now we get down to even worse stuff. 10% or more U.S. shareholder of a controlled foreign corporation. So if there's a 10% more U.S. shareholder of a controlled corporation other than the person filing the form, and 10% or more shareholder of any corporation controlling the foreign corporation. So you have an S Corp, and the S Corp owns this company, you own more than the 10% of the S Corp, you're going to be here. We'll get back to all this in just a second. I really want to look at the instructions just for a few moments. They're really short because I expect the accountant to really know the concepts that are on the form itself. What's important is the functional currency, once again, really important. The forms, as we go through this class, you can see the instructions are brief because they are referring you to a code section or to a regulation. And so when you're reading these instructions, you really have to take the time to pull up the code section. And this was hard about the client. They do not understand that when they decide to do a foreign corporation or even a foreign partnership, they've just decided to spend at least $10,000 more a year with you on doing the forms. Tax planning, to do good tax planning with international, it takes 2-3 months. You really have to drill down to the client's business transactions. You can see that's on Schedule M. And $10,000 to $20,000 at just a standard rate of accounting really is important because you want to be sure that you put everything in writing and you avoid any responsibilities for tax penalties. So lines 14 to 16, and let's just get back over here to this page here. Okay, let's get back over to this page here. I said computer. Okay, line 4 to 16. So 4 is going to seem like a strange firm. Platform contribution transaction payments received. So a lot of jargon on these forms and a lot of tax planning. And down to line 16. Line 16 ends with platform contribution payments. Platform contribution transaction payments paid. So each of these things each of these terminologies is a great tax planning opportunities. And you're going to see as you read through these instructions that the IRS wants to be sure that you look at these type of payments. We're going to get into that in the next slide on the PowerPoint. And they also want to be sure that you coordinate it with the cost-sharing arrangements. Cost-sharing is a method that gives you legitimate tax planning. The IRS wrote some very pro-taxpayer regulations, but the courts have made them even more pro-taxpayer, so I want to get into that. You're going to see here, which is really important, that the IRS wants you to be looking at Section 482. It wants you to read it, wants you to understand it. Intangible development cost is a big item because it's intangible. It's hard to track. The value is intangible. You want the client to spend the time documenting this, getting the proper allocation. Keep in mind, a website can be an intangible development cost. Upgrading it to e-commerce is such a big amount of intangible transactions in today's economies. Lines 9 to 21, so we're going to go back up here. These are the dividends received or paid by the foreign corporation, not previously taxed under Subpart F income. Subpart F income coordinates in with this. When we see the form on earnings and profits, we're going to see how that form blends into this. This is the art form of a Form 5471. It is somewhat a 2- or 3-dimensional form with you needing to coordinate each of the subschedules to really understand what's going on. We're going up to the top here, going up the top slowly but surely. Okay. Okay. I I told it was going to be slowly but surely. Okay. I told it slow. Okay, here we are. Lines 25 and 26, really important. Back to thin capitalizations, also investment in U.S. properties. This is a real firecracker of a line. You can't understate its importance. And it says, report on these lines the largest outstanding balances during the year of gross amount borrowed from and gross amount loaned to the related parties. Do not enter aggregate cash flow, comma, year-end loan balances, comma, average, or the net, and especially not the net, because they want, just like all of our CPAs, we know if a journal adjustment's off by $1, we need to find out what it is, because that net of $1 could represent 1 million on one side and 999,000 on the other side. Do not include open account balances resulting from sales and purchases reported under other items listed on Schedule M and are collected in the ordinary course of business. And in fact, accounts receivable, accounts payable. So this is really going to be looking at the thin capitalization issue, and to the extent they can find you making a loan in U.S. property, they'll be very happy, because as we would discover, that is a taxable event. So now we're going to try to get this form to get a little bit bigger for here on us, and I am going to do you to make you bigger, and now we're into the form itself, which is very nice. So we want to make this even bigger. That's what I want. Name person filing the form. That's the person who owns more than half the value or half the voting rights. Foreign corporation, as I stated, try to always have an EIN number, really important. Reference ID, that's more your internal items. Keep in mind, all amounts must be stated in U.S. dollars translated from the functional currency at the average exchange rate for the foreign corporation's taxable year. And I stated before, different parts of the Form 5471 have different rules for the translation. So transactions of the foreign corporation, this is the controlled foreign corporation, and this is with either the U.S. person, and as we stated out, a domestic corporation, another controlled foreign corporation, 10% of an entity that you own that's a controlled foreign corporation, or 10% of a corporation owning the controlled foreign corporation. So they're really trying to look what's going on. And so here's your planning, stock and trade of inventory. If this is your case, you know the IRS is going to monitor this, so Section 482 is really important, and you getting your pricing right is important. The Obama administration told Treasury to have a quick advance pricing agreement for small business, and I really encourage you to use that. Sales of tangible property other than stock and trade, hardly ever does this take place. This would be, I don't know, a big piece of equipment, something of that type. Sales of property rights, okay, so property rights is not the sale of the intangible. Property rights is even more broad-based. So this is almost when you need, if a client is dealing with such things, you need your attorney involved. Keep in mind the IRS is still using ancient concepts of patents and trademarks, etc. as the sectors I assume is copyrights. They're not into this line's not into intangible assets that's not somehow created by a government filing. Platform contributions, we'll get to that in the next slide. Cost sharing transaction payments, we'll do that at the same time. Once again, great tax planning. Compensation received for technical, managerial, engineering, construction, or like services. So this is transactions of the foreign corporation received from a related party to the foreign corporation. This is a commission received by the foreign corporation. The IRS is asking all this. Let's look at line 6 and 7. Because a lot of people come to me and say, I'm shifting my income offshore or onshore with a management fee or custodian fee. The tax courts are really good wanting to know how many hours you spent and what took place. If it's a bogus or phony fee, then you call Ken Burrish because you're right on the edge of a crime. You may even be in a crime. Same with the commission. Unless the commission is something that makes sense, you want to keep Ken Burrish's phone number on your speed dial because you're going to need him. And once again, Ken and I do come in and we do kind of do a make-believe audit for CPAs who want to kind of get ahead of the curve to see what they should do or what they should clean up. Rents, royalties, and licensing fees. This is really important for two things. One, these items are most likely Subpart F income from a related party. That's almost the definition of Subpart F income, or it is the definition. And two, if somehow you got around the Subpart F, which is the way to do that is that you have the property in the foreign corporation and the corporation property are in the same jurisdiction. So you'd have a Cayman Island company with a Cayman Island condo and you're paying rent for it. But the other thing, of course, is Section 482. Dividends received exclude the deemed distributions. Now that has to do more with C corps, so it's not going to be most of our clients, or distributions of previously taxed income. We'll get to that when we get to the earnings and profits. Interest received, once again, probably Subpart F income because from a related party, and Section 42. This has to do with captive insurance companies or cause a hot issue with the IRS. The same thing's going the other way. The foreign corporation is buying stock and trade from somebody onshore or a related party. And it's all the way down. And the same rules apply both ways. The last part, of course, like I said, is amounts borrowed and amounts loaned. In summary, you want to really sit down with your client before he starts his business with Form 926 and with this form and plot out his business plan, because quite often they have made up their business plan with no understanding as to the tax consequence. This gives you a great checklist. What I like about it, it gives you a checklist of all the possible companies that the client could have. This is by far the best way for you to really be sure that two things are going to happen. One is that when you are doing the return, you are not going to be surprised and give your client bad news and have them upset at you. Secondly, your client's going to have the maximum tax savings. Quite often, we will have the client get appraisals. We'll do all the items where I could dot an I and cross a T before the client starts the business transaction. So I'm going to end this video here. We'll get back to the earnings and profits a little bit later, but first a little bit more of the class and questions and answers.